Well, good evening, everyone, and welcome to tonight's webinar, Wealth Checkup, Super and Investment Essentials for the Medical Professionals. We're glad you can join us this evening and go through this engaging session, especially designed for doctors and medical practitioners. We have a great speaker from our platinum partner, Cutcher Neale, to take us through this presentation tonight. But first, I'd like to do an acknowledgement to country. We acknowledge the traditional custodians of the land in which we work and live. We pay our respects to elders past, present, and extend the respect to all Aboriginal and Torres Strait Islander peoples today. My name is Kathy Ball, and I'm the membership lead at AMA Queensland, and I'll be introducing our guest speaker from Cutcher Neale a little bit later. But first, we have some housekeeping notes. The presentation will take about an hour this evening, with plenty of time at the end for questions. However, please note that we do have a chat box, so you can please place your questions there. We have muted all our guests while we go through the presentation, but keep those questions coming in to get the best out of this evening. Also note, with our partnership, the AMA Queensland has with Cutcher Neale, our members get a 1 free hour consultation with them. Everyone's financial circumstances are very different and very personal. And if we don't get into the depth of what you need, once again, please take advantage of this free consultation with Cutcher Neale. I'd like to just mention some of the upcoming events that we have this year. We do have our private practice refresh strategies to grow your business. This is a seminar series that will help you gain knowledge and tools needed to build a thriving and long-lasting practice. The event will be held in 3 locations: Brisbane, which is actually tomorrow night. We're going to go up to Townsville on the 18th of July, and we'll be on the Gold Coast on the 5th of December. Tomorrow night, for our members who are in Brisbane, we do have our member networking evening, which will be from 3:30 to 6 at the Indigo Hotel. In mid-July, we do have a member networking event up in Townsville, and that's on the 17th of July from 5 to 7. And on the following day, up in Townsville, we do have our Women in Medicine breakfast as well. Later on in August, we do have our Senior Doctors Conference, which is in partnership with ASADA, and that will be held in Brisbane at the Voco Hotel. And we also do have our annual conference, which is the international one, and this year we're going to Vancouver in Canada. So if you're looking for a holiday and you need to earn those CPD points, please definitely consider this event to come along. We also do offer our members a 25% discount if you do refer a member to us. You just have to get them to write your name down on their application form, and you will receive a 25% discount on your following year membership. If you refer up to 4 members, you'll actually get a complimentary membership for the year. I'd like to introduce tonight's speaker, Sav Angie. He is our corporate partner from Cutcher Neale. Sav will be taking us through super strategies for long-lasting security using a property within super, what to consider and how to structure it, current investment market outlooks and how to navigate the uncertainty with confidence, advice tailored to your medical career stage and goal, and superannuation tips that can lead to increased wealth in retirement. I'd like to say please welcome Sav from Cutcher Neale.
Thank you, Kathy. And just a quick tax tip for those of you interested in doing the Vancouver trip later this year. Keep in mind that it could be tax deductible, not to mention the CBD points that Kathy mentioned earlier. But if the main focus of the trip is to visit the conference, then obviously a tax deduction is possible for your flights and airfares. If you decide to extend that trip to some personal time as well, then potentially you need to do a bit of a pro rata of those other expenses. But let me get on to tonight's presentation. Cutcher Neale's been around since 1953. That's actually our head office there in Newcastle. We have a wealth of knowledge when it comes to the medical and dental areas. We do a lot of work with medical and dental professionals. We have some 2,200 medical clients that we work with on a regular basis. Here's a bit of a snapshot of where we are. So I'm actually talking in the Brisbane office at the moment in Fortitude Valley. Head office is Newcastle. We also have an office in Sydney, and recently we can also proudly say that we're now expanding into Melbourne. The blue dots you can see though are all where our clients are located, so pretty much around the country, a couple internationally as well, but obviously a big focus on the eastern seaboard because of where our office locations are. But I myself work with clients from North Queensland, Townsville and Cairns, all the way through to Melbourne. So I've got a spread of clients across the eastern states at least. Something that we've put into place and formalised in probably the last 12 or 18 months are our core values. So what we do together with our clients is we try and build strong relationships where they can see us as their trusted advisors. We'd like to think that as a firm, we are always innovating. We like to build a relationship and deliver or even go above and beyond our promises. So we'd like to think that we're true professionals. As a team and with our clients, we like to make a solid connection there. And so we feel that as a team, we're stronger together. Further than that, we also do a lot of work with the community, whether it be fundraising or other sort of charity events. And so that's what we'd like to call our Beyond Cutcher. This is a bit of a snapshot of what we do as far as being able to offer services to clients. We're not just about accounting and tax. We do a whole host of other things to do with finances and superannuation and so on. So we call this our 7 pillars for success. We can pretty much do everything from helping you, get a mortgage for your home or investment property, finance for a practice purchase or a practice premises, through to superannuation. So whether it's retail super or establishing a self-managed super fund, financial planning, so wealth creation. I'll touch on a little bit of that tonight as well. We do have also in-house risk and general insurance team. So whether you need a complimentary review of your income protection, life, TPD, trauma, or whether you're in practice and need assistance with medical indemnity, business packs, public liability, cyber insurance, those sort of things, we can help out. And even if you get a home or car insurance renewal come up, you can flick it through to us and we can provide you some competitive quotes. Separately to that, we also help our clients get established with cloud business software. So Xero accounting software is typically the software that we do use, and can assist in the way that sort of integrates with your practice software. I've got estate planning showing there because it's something that we like to talk to all of our clients about, not something we can do directly because we're not lawyers, but in partnership with some lawyers that are also or do a lot of work with AMA Queensland, we can certainly help making sure that you've got the right will and estate planning in place, because after putting in so much effort to actually develop and build and grow your wealth, you want to make sure it's protected and preserved. All of you have probably heard this saying, quite common. So it's all about planning, and it's never too late to start planning. It's never too late to start building the right foundations. It can make a significant difference to your future. This is a bit of a picture. We like to call it the journey, but this is where we can see our medical professional clients end up in, down the track, 10 or 15 years time, depending on, where they are in their career. For some of you, you may have a family, you may have started into your specialisation, or whether you're going down a GP or a physician pathway or something like that. That could involve some, the right structuring to make sure you're in the most tax effective structure. Could involve having, say, an investment company or a family trust, could involve a service entity in there as well. You may have built up enough in a super fund to then have a self-managed super fund, which can buy your medical premises, which I'll also go in a little bit more detail. That fund may also have a share investment, but personally, you could also have your family home and a number of investment properties. So it's what's possible with the right planning. Structuring can be quite complex because of looking at so many different options. We'd like to think that really not one size fits all. The end result is subject to your personal situation and your goals, and there's pros and cons of each. So a company can provide excellent asset protection where a professional operates via a company, but there's also added layers of tax legislation. So you need to think about things like personal services income legislation, for example. So typically a medical company can't retain the profits that the medical professional has generated by their own efforts, but it can be used for something like a service entity, for example. Typically we see that operating as a sole trader gives you the best flexibility and then access to things like, capital gains tax discounts. And because obviously your personal exertion or your personal services income needs to come through to your name, it does have the highest marginal tax rate, but still gives you the maximum flexibility. The other structures can come into play at various different times. Obviously your best taxed environment there is your self-managed super fund. And if you get to pension phase once you've retired, then you can basically pay as little as zero tax. So quite an attractive investment structure there. We always start with basics when we're ensuring that our structuring is right for your personal circumstances. We consider it every time we're establishing a new entity for a client. So we've got a couple of sides there. So the part that's surrounded by the little barbed wire fence is what we're trying to protect from litigation. Okay, so as a doctor, or if we look at the left-hand side, as a doctor, potentially you are exposed to litigation, say from, that's why you have your medical indemnity insurance. Procedure goes wrong, something happens, you could get sued, you need to have the right insurance. Service trust, it typically operates your practice and runs your business. There's issues there potentially where there could be litigation, and that is probably more likely to fall into things like public liability or where your cyber insurance comes into play. And as a director, you also take on the responsibility of a company and other person that if you're going to be sued, the director is the person that is the one that's front of line there. So we offer these layers of protection by having valuable assets in your self-managed super fund or a family trust or investment company to keep that separate, where we want trying to grow and preserve our wealth going forward. This is sort of the ideal structure, I guess, when we're looking at strategic structuring. So as a doctor, you're going to be generally earning top marginal tax rate. In a lot of cases, you're able to structure by having a practice entity. This can be either a family trust or a company, depending on, I guess, how you're proposing to distribute any profits. You would typically pay a service fee across to the practice entity. It then, using that service fee income, hires staff, pays rent for your premises, looks after overheads, and then any profit left at the end of the day. If you're using a medical company, if you're using a company as your service entity, will pay tax at marginal rates, at marginal rate of 30 cents in the dollar, or 25 if it's actually considered a business, 30% more so if it's has passive investments in there. If it's a family trust, you can then use that to effectively split income to, say, a spouse or adult children. That service entity, as I said, pays things like rent. Ideally, if you have a property that's being bought by your super fund, then you are assigning that rent across into the lowest taxed environment. So we're reducing our tax rate. So originally, as the doctor paying a service fee, you're getting a deduction at 47 cents in the dollar. Your super fund, once it gets the rent flow through, is only paying tax at 15 cents in the dollar. So great structuring there. Superannuation, why do we talk about it so much? Again, 15% tax rate. You can't get better than that in any entity at the moment. There are new rules, or the rules have been around for a little while now, but it's getting harder and harder to put more and more money into super. We've got these caps that we've got to be mindful of each year. You've got your concessional cap, which has just been increased to $30,000 in this financial year. You've got your non-concessional cap, so something that you make an after-tax contribution, $120,000 with a $360,000 bring forward arrangement for 3 years. I guess we try and aim for a $2 million target by age 60. That's not necessarily the end goal. It's just a good target to get to. But keep in mind that anything that you do put into super can potentially have a fairly long time before you can access the funds, depending on what you do with those funds. But golden rule, invest early, because with the power of compound growth, can put you in the best position as far as building up that retirement nest egg. Self-managed super funds are a big thing in this country. The total asset value in self-managed super funds has now hit the $1 trillion mark. Obviously, there's a lot of pressure from the government. The industry funds have, I guess, put up their objections to why they don't want our SMSFs around, and that's because they lose a lot of money that they manage themselves. But the self-managed super funds are still growing quite rapidly. I think at one point it was about 2,000 new SMSFs every month. We do quite a few of them with our medical clients, and it's the ideal way to be able to buy their practice premises. Again, more wealth in retirement. The more you put into super, the less tax you're paying at the end of the day. A superannuation fund, being a trust in another form, provides you the best asset protection. Keep in mind that it is hard to access once contributed because of that long time frame to when you do actually get access to that. But I'll elaborate on that a little bit more as well. For those of you that are employing staff, the SGC or super guarantee rate changes from 11.5% to 12% on 1 July. That's the last legislated increase we've now got for superannuation. Some of you, depending on your age, may remember when superannuation was only 3%. It's come a long way since then. It's taken a number of years to get there, but we finally got there. Keep in mind also Division 293 and excess contribution. So for a lot of you where you're earning more than $250,000 of taxable income, instead of paying 15% contributions tax by the super fund, you'll be paying 30%. And you've also got to be careful if you go over your $30,000 concessional contribution cap, you could also be penalised as well. But having said that, 30% in the superannuation environment is still better than 47% personally. Keep in mind, again, that compounding effect, the less tax, the more growth, superannuation is still a great place to be. For those of you that have got superannuation balances under 500,000, you do have the ability to use any unused cap balances that you've had for the previous 5 years. So at the moment, this current year, $30,000 is the cap. For the prior 3 years, it was 27,500, and the year before that was 25,000. So if you're in this position and you do have some available cash flow or are looking for a last minute tax deduction, then you can go back over the last 5 years and use up any unused contribution. In some case, that can be from 30 or 40,000 all the way through to over $100,000, depending on how much super you've had contributed over the last 5 years. There can be a reason why you'd want to make a big contribution to use up your unused concessionals, and it could be if you've been on parental leave and you're returning to work, or for some reason you've just received a big salary increase and you've got some surplus cash, or if you've had a big capital gain. You sell an investment and you've actually made a big capital gain and you want to try and reduce the capital gains tax on that. Could be the right timing to actually make a carry forward catch-up contribution with your concessionals, use up what you've had there in the background, and that will reduce your capital gains. Now, keep in mind, with the rollover to 1 July coming shortly into the next financial year, the carry forward unused concessionals from the 2020 financial year will drop off, and they won't be available anymore. So if you don't get access to them now, they've gone after 30 June. To be able to access your carry forward unused concessional contributions, though, you have to maximise this year's contributions first, and then the tax office will automatically go back and start eating away at your unused concessional contributions. This is a bit of an example where we've got a 33-year-old who's on, say, a salary of about 165,000. The SGC is sitting at around the $19,000 mark there. If we look at maximising their super to fill up the cap for $30,000, that difference between their current age of, say, 33 and retirement at 65 can make a massive difference of about $700,000 plus. So definitely worth considering if you've got the ability to do so. And obviously it all comes down to your available cash flow. I mentioned the non-concessionals before, where if you're making after-tax contributions, you can use $120,000 worth of non-concessionals for 1 year, or you can go up to a 3-year bring forward. This can have an impact depending on what your total super balance is. More so of an issue when you're getting close to retirement in terms of how much you can convert into pension phase. So as you get closer to that magical balance of the 1.9, which is going to be indexed to $2 million on 1 July, the availability of how much you can actually use as that bring forward is determined by what you've got at your previous balance as at 1 July. I mentioned that $120,000. So the recycling strategy. So when you have a super fund that has, say, older members and they're, say, in retirement phase, they're on a pension and so on, there's what we call, I guess, an inheritance tax on superannuation balances. So where you have a member's balance that was predominantly made up of concessional contributions along the way, so anything that you claimed a tax deduction for, there is it's treated as a taxable component within your member's balance. Anything that goes in as a non-concessional contribution is treated as tax-free. So ultimately, when you pass away, any superannuation member's balance that you've got left, if you, for example, leave it to a dependent spouse, then there's no tax on that component. If it comes out of a super fund and is paid to a non-dependent, say, adult child, then there is tax at 17%. So it's 15% plus the Medicare levy on that taxable component. But with the benefit of time and some planning, we can actually use what we call a recycling strategy. So once our super fund clients that are in pension phase are able to withdraw pension amounts, which are tax-free to them in their personal name, if their cash flow allows, they can pull out a certain amount as a tax-free pension and then put it back in as a non-concessional contribution. And so what that does is it recycles any taxable amounts that you had within the fund into tax-free amounts within the fund. And that sort of strategy can work quite well up until the age of 75. So you can effectively reduce your taxable component to tax-free, which means then ultimately when yourself and a spouse, if any, pass away and you leave money to, say, adult non-dependents, like whether it's children or other family, instead of paying 15% plus the 2% Medicare on your passing, there's essentially no tax on that. So it would be then tax-free to them. So it's also a good way if you've got say a couple where one member's balance is higher than the other and you want to be able to equalize the balances, you can withdraw the pension from the member who's got the higher balance and recontribute it in as a tax-free amount into the member's balance that has the lower balance. So it can actually equalize those two balances. Something that could be, I guess, quite important with this possible implementation of the new, what they call Division 296 tax, with the $3 million balances and tax over that. Keep in mind that it's the $3 million balance per member, not for the fund. So if you do have the opportunity of I guess, equalising members' balances, you essentially won't have any issues with this Division 296 tax until you get to about $6 million in total benefits. So that can be a really good planning strategy. Superannuation, that's what we like to call the legal tax haven. And the reason is because there's a big difference between tax in your personal name at 47 cents in the dollar or tax in the super fund at 15 cents in the dollar. So this is a bit of an example. If you have contributions into super and you've got some rent in the superannuation environment, being taxed at 15%, you're left with a lot more cash than what the equivalent would be in your personal name. So where you're not making the contribution, and let's say you had a rental property earning you net rent in your own name, then you've got a significantly higher cash position available in the superannuation side and provides great asset protection and tax efficiency. A couple of options for buying property in super. So this is a way that a lot of our medical clients are going, because they want to either own their own medical suites or consulting rooms, or potentially even a whole building. So there's a number of different options. So if you had a significant amount in your super fund, you could actually buy the property outright. That's not always possible depending on your balance. So with an SMSF, you can also borrow. So that includes, not included, it is called limited recourse borrowing arrangements. So fairly restrictive requirements. So unlike an individual going to the bank and wanting to borrow money for their own home or an investment property or something, you are able to borrow between, say, 80 and 95% as an individual. In a self-managed super fund, your limited recourse borrowing arrangements are a lot more restrictive. In a lot of cases, you can't go past about 50 or 60%. There's also restrictions on what you can do with the property. You can't significantly change the property or renovate it, for example. So there are some pretty tight restrictions on that. Sometimes you can use a related trust. So depending on what value of property you're trying to buy, you might not be able to do it all on your own. You might need to get involved with a few other people. So there's a couple of options there. And another one's an unrelated trust. I'll go through these in a little bit more detail in a sec. But then you've also got larger property trusts and managed funds. So that might be a more indirect property option where you're investing with someone like Global Property Trust or BT, or someone like that, where they actually hold a whole portfolio of property. You're just buying units in one of their listed funds, and you have an indirect property exposure. As I mentioned, there's some pretty significant restrictions on limited recourse borrowing arrangements. You can't do constructions, you can't do redevelopments, you can't do major renovations. It also is subjected to higher interest rates. So where personally you might be able to get home loan borrowings at under 6% at the moment, you'll be typically paying a margin of maybe a couple of percent if you're doing it as a limited recourse borrowing arrangement. Additionally, there is a higher cost of establishment. You need to set up a bare trust. There's only certain banks that will actually do those type of borrowing arrangements. So it will typically cost you a few $1,000s more to set up from the beginning. But sometimes it's the only way that people can do it if they don't have enough money in their super fund. With your borrowing, typically there's a limited number of lenders that will do it, and the borrowing amounts or percentages are restricted, and your terms typically, so I mentioned you could borrow, say, 90% as an individual in your super fund, 70% you might get some banks go to as high as, and typically where in your own name you could borrow for a home up to 30 years, and in some cases 35 is a fairly recent introduction into the loan market. Super funds are typically allowed not to go any longer than about 15 years. Okay, that's what we call a related party borrowing. So you can have a look here. The variable interest rate is significantly higher than actually borrowing in your own name. The other thing we've got is a related trust. So this is where there is no borrowing within the super fund, but it's borrowed separately outside by a related party. So one of the members personally, let's say, borrows some money, contributes and buys units in a property trust. So again, there's no borrowing in the unit trust itself. The unit trust owns the property, and then the super fund invests in that unit trust. So we call that related because all the parties in this particular transaction are all related to each other. But the borrowing cannot be within the unit trust or the SMSF. It has to be outside of that. An unrelated trust is actually quite a good vehicle where you have parties that want to buy, let's say, a bigger value property. They can't be related to each other. So this oftentimes can be where you have medical professionals who may work together, in business, in a practice, aren't actually connected by any other way other than sort of working together. But they say, hey, we'd like to get together, pool our funds and buy a property. We'd like to borrow because our funds don't have enough, but you can actually bring in family trusts and things here as well. But again, they can't be related to each other. But the property trust itself in this instance can borrow, and then it buys the building, which is then rented generally to the related doctors there as as their principal business premises. So there's a few different options there in terms of the level of debt, basically, or debt required. Some structures will allow you to have debt, others won't. I gave a little bit of a summary on that, but if you've got any more questions, please ask. I can go into a little bit more detail. Benefits of having property in your super. So where your super fund or your unit trust owns the business premises, you're maxing out your tax rate at 15%, or effectively, if your super fund is in pension phase, then your tax can be as low as zero. If your balances are under that $2 million mark that's needed for the transfer balance cap, and you both members are in a pension phase, then your tax can be as little as zero, which is great if you've made a substantial capital gain on that property over the years and ultimately you want to sell it one day. Then it's a really great way to essentially pay no tax on that capital gain. It's a really good idea when your tenant is a related party. So you, as a medical professional renting your own property off your own super fund, you're making yourself more wealthy. You're not making an independent landlord wealthy. You can still make further contributions, whether it be deductible or not concessional or non-concessional, to pay down any debt, let's say in the super fund or the unit trust in this case. I mentioned before that if you sell in pension phase, it can be tax-free. But again, probably one of the biggest and most important items is that the property is in the best structured vehicle for asset protection. Downsides of property and super: all of the transactions need to be at arm's length. So they need to be on a commercial basis. You can't go renting the property at a discounted rate. So it needs to be at a commercial valuation. You then need to get an appraisal on both the value of the property and the rental. Typically that needs to be done every 3 years in a super fund. It doesn't need to be done by a formal valuer. It can be done by a real estate agent, but they need to be able to provide some proof as to how they've come up with their valuation for the property and the rental appraisal. So typically they need to, I guess, look at comparable or comparative sales in the area to try and justify those appraisals. Capital works. So let's take an example of a builder who has a self-managed super fund and decides to do some work on the property themselves. They can't actually provide things like materials and their labor to the fund because the fund is getting a benefit of that. So that's one thing you've got to be very careful of. You also can't have a property investing in a residential property which is rented to family. So you can have a rental property which is rented commercially at arm's length to the public, but you can't rent a residential rental property to what we call Part 8 associates, so anyone connected by way of a relationship to you, and that extends to business relationships and things as well. But typically a lot of people say, oh, can I buy a rental property in my super fund and have my kids live in there? The answer is no. Keep in mind as well that if you've got property in your super and it's the single largest investment, you don't have that adequate diversification. So, be careful of the risks of having all your eggs in one basket, as that says. Ideally, over time, though, with more contributions and rent and paying down debt, you should have enough spare cash within the fund to be able to diversify into other assets like shares and managed funds and those sort of things, and even holding some cash. So typically what we like to do as part of a good overview of a super fund is set up an investment strategy. Then that's probably the number one item that if your fund ever gets audited by the ATO, the first thing they will ever ask for is your investment strategy, because what they want to make sure is that your super fund investments are in line with your investment strategy. So they can be quite aggressive with that if you're not in line with that. But if you're also very heavily geared to property, which is known as a growth asset, but you as an individual investor are considered, say, a balance or risk averse investor, then it's not going to meet the requirements of that investment strategy, because you're going against that by investing in something that is definitely a very growth asset. I'd now just like to touch a little bit on the economic markets and give you a little bit of an update. So as a firm, we have an investment services division, which I mentioned before. We look after about $910 million of client monies, both within the superannuation environment and outside of the superannuation environment. And we have a number of portfolio offerings between Australian shares, international shares, a positive impact model, a fixed income model, and an alternatives model. And so typically we work with our clients on a risk profile questionnaire that then allows us to determine their level of risk appetite. And then from there, we can then, I guess, put in place the right asset allocation for them, which works in line with their risk profile. And that's where I mentioned before, if your super fund is heavily weighted towards property, then that may not be ideal from either a risk profile point of view or an investment strategy point of view. So again, with a bit of time and planning, we can put the right investments in place to make sure we sort of balance out that investment strategy and that asset allocation. Bit of a wrap up on what's happened in the markets, I guess. There's obviously been quite a few movements recently over the last few months with Trump imposing his tariffs. Over the last couple of weeks, the Australian share market has pretty much got back to where it was before the tariff announcement. Started off last week, fairly positive. We hit some new highs. The talks between China and the US are sort of ongoing. But then we've pared back some signs of these gains because of the geopolitical concerns, especially with the war overseas. As a result, a lot of the big resource companies also lost a bit of their strength, and we saw some values come down on those. Technology seems to be still a growing sector. So the likes of NextDC, which provides backup resources, so like server centers and things, for example, was a bit of a standout. And with the increasing AI technology, there's a new AI facility being built in Melbourne at the moment. So that seems to be really growing that technology sector at the moment. US markets were a little bit lower. We found that, some of those, because of those tensions in the Middle East, some of those gains have been wiped out. Investors are moving away from those growth stocks into more defensive stocks. So the minute Trump announced his tariffs, the likes of Apple took a very big hit in its market capitalization, saw the value drop really very quickly and very significantly. European share market's quite positive at the moment. Energy sector was a bit of a standout because of rising oil prices. So Shell and BP rose quite well. Whereas in the European area, the retail and the financials actually dropped, but not much. They underperformed as the investors started to move out of these particular areas. Here's a bit of a snapshot over the last roughly 12 months. We can see what the markets are doing. The yellow line there being China, quite volatile. All of the major economies are actually higher for the 12 months. China has rallied quite strongly. I guess coming out of COVID, we've seen some major movement there. Australia, there being the green line, we struggle with the lower commodity prices. The interest rate cuts has also, I guess, been a little bit unusual compared to some of the other economies. US has been strong, but they've all had a bit of a drop there at the end, where Trump's tariff and government spending has been announced there as well, the cut in government spending, and we've seen a bit of a bounce back in Europe. So just a bit of a global summary there. Inflation largely now under control. We've seen that come back a bit. We did have a high in the last couple of years of sort of approaching about 7 or 7.5%. Inflation has come back, which has removed a lot of uncertainty and given us more market stability, and that's led to the stronger share market performance. So it's also taken the pressure off the central banks to try and keep the interest rates high. We're still seeing some downward pressure here in Australia. We've had the 2 rate cuts in fairly short space, and we're looking that like there might be a few more actually coming up this year, which could then also push the housing prices up further. This is just a view on the interest rates. As I said, we're still expecting another couple of interest rate cuts coming up this year. When it comes to, I guess, building our portfolios, so construction and trying to mitigate risk, there's a fairly extensive process that we work around. We've got an investment committee. We review constant research. We do risk analysis and so on. And I guess we cover about 1,000 results every year. And that's across our Aussie share, the international share, and the positive impact portfolios, trying to build fairly robust portfolios with some really, really good diversification. This is a bit of a comparison of our retail super offering. So depending, a lot of you will have your default fund from when you first started work. Some of you may have changed to different funds along the way, or you may even have a couple of different funds going because you worked in different jobs as you've been working your way through your career. This is a bit of a comparison between, I guess, some of the major industry funds, and also comparing our Cutcher Neale. These are the balanced funds, by the way, comparing our Cutcher Neale retail fund with, what have we got there? We've got Australian Super, Aware, Australian Retirement Trust, and Q Super. So as you can see there, our retail fund significantly outperformed the other industry funds. So keep in mind that, if you do have an industry fund at the moment, you don't have to leave it where it is. A lot of people look at it as a bit of a set and forget. It is something that you can actually make changes to. You don't have to stay with the same fund. If you do hold insurance within your fund, then that's obviously something to consider, but there's no reason why you still can't look at getting better performance out of your fund between now and retirement age, because that compounding effect of growth can be substantially different depending on what sort of returns your fund is getting. Fixed income opportunity. So we have a fixed income portfolio. So typically this sort of, I guess, is the equivalent of something like term deposits, providing a little bit higher target return, about 2% higher than what the term deposit rates are at the moment. So typically this is based on low risk liquid investments. And so it forms part of a good diversification strategy. So typically our income portfolio is sort of returning about 6.5% at the moment, and is a good defensive part of any portfolio strategy. International shares, I mentioned, a lot of you will be familiar with a lot of these big names. So our portfolio typically has 25 to 30 of the best performing companies in the international markets. They're not all just America. They do range to other countries like, say, Japan and Germany, for example. But we've done a lot of extensive research in the background to be able to find the companies that are producing good growth. There's good future forecasts for them. Again, obviously offering good diversification. You can see that the US is quite heavily skewed towards technology with the likes of Microsoft, Nvidia, and Apple and so on there. But we do try and balance that up to try and take some of that risk out. A positive impact portfolio. We reviewed this a few years ago. I guess it was initially more designed to be ethical, green, sustainable type investments. What we found, though, after doing some research, is that certain companies that were considered ethical and green and sustainable weren't necessarily environmentally friendly, and actually did have a lot of impact on the environment. So we sort of refocused our portfolio to things where there is actually less impact on the environment. So something like wind farming, which people typically think as green because it's the wind turning some turbines that then produce electricity, is actually very destructive on the environment, both from the green space that's taken up to build these massive structures, to the environmental interference and I guess noise pollution that comes from them, to the bioplastics that break down from the blades when these massive blades are turning around. And then they also have a fairly limited life span. My understanding is they last about 20 years, and that's the end of their life cycle. So they need to be decommissioned, and it's probably not that easy to dispose of a massive wind turbine that stands probably well over 100 meters tall. The Aussie share portfolio, again, some really good names in there. We've selected sort of the top 25 to 30 companies there, done a lot of research into things like growth targets and dividends and future forecasts and so on. There's a lot of names that most of you would recognize. Xero is one I mentioned before as what we use to recommend to clients when they're running their own businesses, to track all their income and expenses. And then you've got obviously some of the major banks and that sort of thing in there as well. The airlines, Life360, a new app that can, I guess, help locate your kids and that sort of thing. So there's a number of different diverse investments there that help, I guess, take some of the risk out of our portfolios. Something that we introduced, I guess, in the last 12 months is alternatives. This is a bit of what we call a catch-all asset class. So it can include multi-strategy type investments or private credit, something that's a little bit different. And typically we look at something that, I guess, takes a little bit of the volatility out of the stock market there. So typically, it sits somewhere between normal equity and your income, like fixed income alternatives. So the risk is, I guess it sits somewhere between the two levels there. With alternatives, obviously, it's something that's a little bit different. So, our comment for this one is, before investing in alternatives, just be aware of what you're getting into. Obviously, we do a lot of research in terms of what we're investing in. Especially when it comes to private credit, there's a lot of managers offering portfolios with only a few loans, whether they be with development or construction. And some of these managers have only been operating for a very, very short time. So that can create a certain amount of risk within those particular portfolios. So just something to be aware of there. These are a couple of the names in the alternative space that we invest in. KKR, a fairly big name that's done a lot of private buyouts over the recent years. So they were involved in the likes of things like when Myer got bought out and taken off the stock exchange a number of years ago as part of the split off from the Coles Myer group. So some of these names have been around for quite some time. So that's about it from me as far as a summary of the investment markets and so on. If anyone's got any questions relating to anything that I've gone through tonight, please pop it in the chat section. Otherwise, I think my contact details, there's a phone number there, but you can reach out to me, whether it be directly via that number or via AMA Queensland, and I'm happy to answer any of your questions. And as Kathy mentioned before, we do offer a free 1 hour consultation to anyone interested in finding out a little bit more about our services. So please feel free to reach out with any questions.